Are you a day trader? Are you trading stocks but not sure if you're really considered a trader by the IRS? Want to find out? Well, we're about to break down the differences between traders and investors and how the IRS classifies the two. Stick around to the end as I give some key tips to keep in mind. Hey there, tax warriors. Welcome to JDB Tax. I'm Brian Eustache, enrolled agent and tax strategist. But I call myself a tax tactician leveraging the tax code to build your financial fortress. And with this segment of Tax Tactics, we're tackling a topic for all you stock and securities enthusiasts out there. Do you qualify as a day trader in securities for tax purposes? And what does that mean for your tax reporting? Let's get this sorted once and for all. Being a trader as recognized by the IRS isn't just about buying and selling securities. It's about meeting specific criteria that sets you apart from investors and dealers. To qualify as a trader, your trading activities must be substantial, frequent, and continuous. You aim to profit from daily market movements, not dividends or capital appreciation. This classification impacts how you report income and expenses, making it crucial to get it right. Also, if you'd like to see more tax content like this, hit the like, comment down below. So, investors versus traders versus dealers. What's the difference? First, investors. They buy and hold securities for personal gain, eyeing dividends and capital appreciation. Investors report gains and losses on Schedule D and Form 8949, dealing with capital gain taxes and wash sale rules. Now, dealers, these folks are in the business of selling securities to customers as part of their regular business. They maintain inventory and have specific tax obligations and benefits under IRS regulations. And traders. Here's where it gets interesting for you day traders. If you're engaged in trading with an eye on the daily market, listen up. You might qualify to file your expenses on Schedule C and opt for mark-to-market accounting, which brings us to our next big point, the mark-to-market election, which is a game changer. Under Internal Revenue Code Section 475F, traders have a unique opportunity to adopt the mark-to-market method of accounting. This method allows you to treat gains and losses from sales of securities as ordinary gains and losses, not just capital ones. What's the benefit? No limitations on capital losses and bye-bye to wash sale rules. But remember, you've got to make this election by the original due date of your tax return, no extensions included, for it to count for that year. So, how to make the mark-to-market election? Attach a statement to your tax return or extension requested by the deadline and include your intention to elect under Section 475F, the first tax year the election applies, and specify the trading business it pertains to. Then there's staying compliant. Once you opt into mark-to-market, it becomes the only permissible method for accounting for your securities. Want to switch back or change method? That requires another formal election and possibly a user fee. So make sure you're committed before you opt into this election. Now, what really qualifies your trading activities as a business, not just a hobby? Here's what the IRS looks at to see if you're truly in the game as a securities trader. Holding patterns. How long do you keep these securities in your portfolio before letting them go? Shorter holding periods might point towards trading as a business. Then there's trading volume and value. How often are you trading and how much money is moving in and out of your account? High frequency and significant dollars show serious trading. Then income intent. Are you trading to pay bills? If your primary goal is to churn a profit for living expenses, the IRS is more likely to view your activities as a business. Then time investment. How much time are you dedicating to trading? More hours suggest a professional level commitment. If your trading doesn't stack up to these criteria, you might just be an investor in the eyes of the IRS, not a trader. This distinction is crucial because being labeled as an investor means different tax rules apply to you. Even if you call yourself a day trader, without meeting these benchmarks, you're still considered an investor to the IRS. For those who mix it up, trading some securities while holding others for investment, you're gotta keep sharp records. Make sure to clearly mark which securities are for trading and which are investments, ideally by keeping them in separate brokerage accounts right from the get-go. This is how you make sure you stay on the right side of the IRS's rules for traders and investors alike. So keep these factors in mind, maintain detailed records, and ensure your trading activity aligns with the IRS's expectations for a trading business. Why does this matter to you? Understanding these distinctions and tax rules isn't just academic. It affects how much tax you pay, how you file your taxes, and how you plan your trading activities. Whether you're a casual investor or looking to make trading your full-time gig, knowing the ropes can save you time and money. If you're a trader or someone who elected for the mark-to-market election, there are a lot of tax strategies you can leverage to minimize your tax position. That's just one of the ways JDB Tax Strategy helps business owners legally save money on taxes without fear of the IRS by leveraging the tax code to the fullest extent. After booking a consultation call with us at jdbtax.com, we'll build a personalized battle plan to minimize your tax burden and maximize your wealth. So subscribe, hit that notification bell, and click all to join me on this epic quest to conquer taxes and claim your financial throne. I post tax tactics every Tuesday and Thursday. See you next time, tax warriors.